This content is general in nature and should not be considered financial advice. Please listen to the full disclaimer at the end of our podcast. All right, ladies and gentlemen, welcome to another episode of our Property and Finance podcast. Today we have a new guest speaker. We have Phil Tarrant from the Smart Property Investment Show. Phil, welcome aboard.
Mate, thanks for having me. It's good to see you, Theo.
So Phil actually runs his own interesting podcast, a very well-known podcast in the property investment world, and he gets very interesting guests. And sometimes I feel it's instead of being the host, it's good to sometimes be hosted, and then you can share some of your words of wisdom that you've learned from all your various guest speakers you've had on your own podcast. In addition to that, Phil has a bit of a property tech disruptor, you could say, a business in the property tech space that's disrupting property management, which we'll cover later. But I guess the real goal from today's podcast is really to get your lens on the world of property investment, because there's been a lot of noise in this space, a lot of finance and property influencers these days on TikTok and Instagram. And I feel that buyers are getting a little bit overwhelmed with the abundance of information out there. And also there's the landscape at the moment in terms of the global economy, even the local economy, with interest rates and inflation. It's been overwhelming in itself. So I thought, what a better guest to have than yourself to give your view on things. So Let's start off with that. Tell me, Phil, what are you seeing out there at the moment?
Well, what am I seeing? Where do I start? But thanks for the invitation to come on the show. And maybe we'll do this bit of a crossover. We'll put up on the Smart Property Investment Show as well. And for
sounds good.
A lot of you who don't know, Theo probably talks himself down a little bit, but I've been very aware of Shore Financial for many years. You're one of the guiding lights of mortgage brokers in Australia, and probably one of the larger. Well, you win all our awards for Australian broking. Are you going to Australian Broking Awards? That's coming up soon.
Yeah, we go to them. But I feel like you got sick of giving them to us, so you're sharing the love these days.
You've been at it long enough now. You won all the awards. Give it to the new people. But
to probably give a bit more colour to what Phil's talking about, you also run the biggest media or one of the biggest media organizations in the broking industry?
Yeah, absolutely. We work across a whole bunch of different areas, mortgage broking being one of them, something which I'm pretty connected with. I've been sort of knocking around mortgage broking for 20 years, seen it grow from 30% market share to 75% market share, largely driven by organizations like yours who are out there serving Australian borrowers and doing it the right way.
So that's just to give more background. That's Momentum Media, which is in mortgage broking, financial planning, and also accounting.
Yeah, it does. So it works across about 25 markets.
Wow.
So mortgages, the whole wealth management sector. So funds management, superannuation, financial advice, self-managed super, the whole insto space. So the whole gamut from superannuation to advice. We work in and around defence and national security, cyber, AI, aviation, law, accounting, HR, the whole real estate side of things that we do. So there's a lot of moving parts there, which really gives me, great access to all these different markets and really dialed in with corporate Australia. But where I have found a natural home is in and around property and property investment. I'm a property investor myself. And a lot of people would have heard me talk about the portfolio that we've created on the Smart Property Investment Show. But to the point around what I'm seeing in the market right now.
It was quite a broad question, and I was leaving it a little bit open-ended because I wanted you to say it first. But, we touched on offline previously that, that it's, like I sort of mentioned in the intro, there's a bit of a, I guess, a saturation point in buyers advocacy, giving investor advice, which might more be better suited and reserved toward the accounting and broking industry.
Potentially, it's quite a
hot
topical,
topic.
and certainly really something that's emerging now. And if I think of the buyer's agent, I've bought a lot of property, and I've bought stuff myself, and I've also used a lot of buyer's agents over the years, and I've been podcasting now for 10 years this year around property investment. So I've spoken to pretty much every buyer's agent in Australia. And when I kicked off doing that, it was still a really tightly held industry, really tightly held profession. I'd call it a profession. Not many people were using buyer's agents. It was like a really well-kept secret. They had a lot of connectivity with real estate agents. They were, sitting there comfortably on behalf of the investor to really put them into good properties. Now it just seems like every man and his dog now is a
buyer's
buyer's
agent.
agent,
Yeah.
and I question the professionalism of a lot of those new to market buyer's agents. I think a lot of them being attracted into this industry thinking it's an easy way to have a side hustle and make $15,000-$20,000 per property to find people property. But these are big decisions that people are making about wealth creation and having some part-timer out there putting them into properties where they might not even be investing themselves. I just caution the industry at the moment. It's a very tenuous time.
Some of them are just sales agents rather than investment advisors, but they're positioning themselves as investment advisors when they've just got a real estate license.
Essentially, yeah, and buyers agents provide a great service, and I think you need to be really clear about what they do. But not all buyers agents are created equal, and I think a lot of them now are just in the business of finding properties and then selling the property to a property investor through the various ways they do it. It's the new frontier of how do you make money on the internet now? I think it's largely selling courses to be a buyer's agent and then becoming a buyer's agent.
Yeah, well, some of those ads for those courses do spook the idea of a side hustle and earning hundreds of thousands of dollars as a side hustle.
Yeah.
So, yeah.
I think there's got to be a degree of frustration around that, and you think about mortgage broking and, having been in mortgage broking for a while like yourself, they had a real coming of age, right? If I think back on mortgage broking 20 years ago, it was still a little bit of the Wild West. Like it was really starting to find its feet, and you had code of conducts coming through from the MFAA and FBAA, and brokers had to professionalize. And now you have a true professional cohort. You're regulated. You've got standards you need to set. You have best interest duties. Like you need to act and operate as a profession. None of that exists in the actual property buying side of things, and it's a long way from being regulated.
Yeah, a long way. And it's funny. I too can echo your point about how the world has changed, or the property market has changed in terms of habits and of transactions in the last, let's say, 10, 15 years. I started broking probably 15 years ago. And back then, I reckon there was 1 in every 20 buyers probably had a buyer's agent, Now in some affluent markets like the eastern suburbs, the North Shore, Northern Beaches, Inner West, agents are telling us that up to 40 or 50% of the transactions they do have a buyer's agent involved, which is crazy. It's really grown a lot.
It's grown a lot, and I think it's good. It's obviously there's value there, but there's still it still needs to find its feet exactly where it's going to go. I haven't yet really formed my full view of all of this, but it's a inflection point for this sector and this industry, and I'd really caution it to get it right, because there's a lot of ways it can go wrong. And when you start getting, the government's been reluctant to regulate it, and it's very difficult to do that because of the mechanics of how they operate within the sort of corporate structure. It's very tough to regulate. So, the industry should be ensuring that it's self-regulating as much as it possibly can right now, and the direction I see it heading just gives me some concern and alarm. And the issue is though, much like mortgage broking, the industry is professionalized. You have professional operators who are, regulated, but largely doing the right things. I think there's a lot of buyers agents out there who don't even know they're probably not doing the right things. They're providing significant advice to people.
They don't realize the consequences.
They don't realize the consequence of it. And there will be a point in time when it probably stops going up and interest rates start going up again, and there's going to be a lot of angry punters out there who have invested in real estate, and maybe in areas where they shouldn't have, right? And they get attracted to this idea, and this is one of my frustrations with buyers agents at the moment is, the way they're positioning themselves is that they will find you off-market property undervalue, right? There's not that many off-market undervalued properties in Australia. So what you see is that they'll telegraph really good buying, and then look, this has gone up by 20%, 30% in a year in clustered sort of potentially regional areas, and it just buoys it, and it drives it forward, and then someone's going to get stuck at the top there, and that happens, mate. But I don't want to be down on buyers agents; they do a great job. I've used them, and no doubt you interface with them.
So before we dive into a bit more specifics on what you're seeing out there in the world of investing, because like I said, I left that question a little bit broad for you, but I think let's give a bit of a finance update and what's happened since our last podcast, because there's been a lot happened in the world of Trump as well, who's affecting finance markets. And then we could dive into maybe the specifics you're seeing in some of the guests that I mentioned that you host. So firstly, we need to cover the fact that we didn't get that expected rate cut in RBA in July by the RBA. On the 7th of July, I think it was.
Did you call it, or did you
I
call
did
it?
think it was coming.
Yeah.
I did understand Michelle Bullock's comments on why they are waiting, because the monthly indicator, as we always say in our podcast, is not the monthly indicator of CPI is not the one in which they make a decision on for interest rate movements. The quarterly data is a more comprehensive set of information that they use to make a decision. So, but what was shocking was that the ASX RBA rate tracker and all markets and economists were really pricing in a rate cut quite aggressively. The ASX rate tracker was pricing in a 97% chance of a rate cut. It was the 8th of July, it was, not the 7th. So that was a shock. The quarterly data that Michelle is referring to is coming out on the 30th of July, so imminent now. And then the next meeting is early August, 12th of August. So I'm pretty sure we should have a rate cut then. Don't think it's going to be the 50 points that some people thought about in the past, but I'm hopeful. I'm confident. Is that your view?
Well, this is when I normally revert to my usual sort of, I'm just a journalist. It's not my position to really take a view or give
Sure.
armchair economic advice. But someone asked me on the last iteration of the announcements, is it going to be cut? I went, no. And for me, there just wasn't enough in it to actually cut it. And you can get absorbed with all the headline numbers, and economists will sit there and they'll debate it and say, we think it's this. There's just no reason for the RBA to cut. So
yeah, the inflation has been bouncing. All the trimmed mean inflation, the underlying inflation, the one they care about a bit more, that's been sort of bouncing up and down a little bit for the past 6 months, or longer. So it wasn't really justified to keep going. They've already made some cuts, so they do need to keep close eyes on it. It's a bit like what's going on. The other point I was going to reference was what's going on in the US with Trump. Trump is, the limit would be an understatement on the fact that Jerome Powell, the US Fed Reserve Chairman, hasn't made further cuts to the US cash rate. They've already moved about 75 points, but he's saying that they need to do a whole 1% cut ASAP, and he thinks that rates need to be 3% lower than where they are today. But the problem is inflation in the US is actually ticking up recently. So there's actually an argument for Jerome Powell to potentially increase rates. And, he's got, since Trump is really trying to get him out of the US Fed Reserve position, and I think his position's coming up early next year, he won't be in the position as of early next year. I think he might, there could be some speculation that he might actually increase rates as a bit of a FU to Trump on his way out.
Potentially, and the Fed, much like the RBA, should be completely independent of politics. And this was the criticisms a few months ago, where realignment of the RBA board with having favoured people sitting on those boards from the government side of things to apply some pressure to start pushing rates down. Now, the independence of the RBA is sacrosanct. It's got to be independent, and it needs to make its decisions based on the economy at any point in time. But there's a fair bit of money still in the system out there, and if you think of the jobless rate here in Australia, a lot of the health of the economy at the moment is largely supported by government spending. The government is spending wildly at the moment. It's all the investment and all the growth isn't happening in private enterprise.
So what happens if that slows?
If and when that slows, when that tap is turned off, things are going to get a lot tighter quicker. So this is the real intersection between economic policy and sort of budgetary spending on behalf of the government and trying to keep the economy in check. It's a fine balance. I don't. I wouldn't want to be sitting there making these decisions. But maybe they need someone like me and you on an RBA board and giving the voice of the the Australian employer, right, who largely is forgotten under this current government.
Speaking of that jobless rate, the unemployment rate was another focus point for obviously RBA decision making. And in recent news, it did creep up 0.2% from 4.1 to 4.3. So that is, whilst it's not the best for some Australians out there, it is reassuring for an RBA cut because they do unfortunately want to see an unemployment rate around that 4.5% to monitor wage growth, and which is inflationary. So yeah, lots going on out there. So with all that coming to mind, let's circle back to that original broad question and nail down on a few points. How do you feel investors are feeling at the moment? We're seeing a little bit more activity, but there's still a bit of a lack of confidence and momentum in decision making and transactions on the investment front.
Yeah, I think ABS data come out the other week, and I think it's 2023 data, which is the most latest stuff. They're saying there's less investors in the market today than what there was, a year or two beforehand. So there's less
investors in residential property.
And some people would be popping champagne cork, saying, "Hey, it's a great win for the owner occupied
job done
and the first home buyer." But there's a lot of consequence connected in with that. If I had to sort of give a frame of reference to how investors feel right now, I think they're fatigued and they're frustrated in that they're seen to be an easy target for raising tax receipts. So if you think about how our governments operate, federal, state, and local, the property economy is a huge supporter of the tax regime, and property investors feel as though they're an easy target for raising funds or balancing state and local and federal budgets. So there is a fatigue and malaise setting in. I think there's a good reason why the Melbourne or the Victorian property market
got hammered.
Is hammered. You think about Adelaide.
Because they did exactly that.
Yeah, Adelaide, Brisbane, Perth, Sydney all have higher median values than Melbourne, and that's just not right. It's completely out of kilter.
So let's break that down a little bit. So you're right that if we want to support the housing market from a supply point of view, we need to support investors, and that's something that we've spoken about in the past a lot in this podcast. That especially a lot of these brand new units and these developments, they rely on investors buying them because they're attracted to them for depreciation purposes. But they've been less and less incentivized to buy brand new properties these days, and the developers are struggling to make feasibilities stack or get developments out of the ground from a pre-sale point of view because the investors just aren't there. You're right in saying, in the past, I saw a lot of commentary around, should we tax investors more? Should we get rid of the CGT discount on them? Should we get rid of negative gearing? There's been lots of comments in government in multiple elections about those policies being reviewed. However, I did see some economists just recently this week in the news put forward a position of the opposite, of the country, which I thought was quite surprising and good to see, where they're saying maybe we should actually look at incentivizing investors that buy brand new units and increasing the CGT discount to 70% on investors buying brand new stock, which that's a step in the right direction.
Potentially in terms of giving the impetus for developers to develop. The counter of that, Theo, I would say, is that if you're a property investor and you're buying off the plan apartments,
I know where you're going with this.
I would probably say if you're looking to build long-term wealth through property, might not be the ideal first or second property you should be buying. There's a lot of reasons why, and again, the ABS data has come out. There's a good reason why, 70%, I think the number is, of all property investors own one property. Typically the reason why is because they bought the wrong property first. They bought it for the purpose of maybe some tax breaks and negative gearing and getting some depreciation off the back of it, right? Like, even though we've been podcasting for 10 years and there's podcasts all over the place, like I think Australians are a lot more educated around property investment decision making, right? However, there's still a lot of people making the wrong investment decisions, and I'm not here to beat up off the plan properties because under the right circumstances, that may be a good approach. But incentivizing people to buy new properties when there is something like, I can't remember the number, 40 or 50% of the price point is connected in with government taxes and other bureaucratic red tape in order to get that property out of the ground, plus the developer margin, you need to sometimes sit around for a long time to wait for that property to actually be worth what you paid for it. And that's okay if you're buying a home to live in and that's going to be your forever home.
But, so then on that note, let's break that down in terms of, trends in the past and, what you're seeing moving forward as opportunities. So, once again, offline, just before this podcast, you and I were having a bit of a yarn about places like Rockhampton.
Yeah.
That there's a lot of buyers agents pushing areas like that. There's been a huge amount of interstate investing, and I believe in some of that interstate investing in cities like Brisbane. But then there's some regional and sub-regional investing. What's your thoughts on all that?
Well, we have a very vibrant and diverse country here, and the regional areas in many ways are the heartbeat of those communities, and it's where Australians are choosing to live in order to maybe combat some of the challenges around cost of living and all that sort of stuff. But when you come into property investment, regional markets, there is a lot of big proponents of regional markets, and I think as a property investor, that's all that may be available and accessible to you. To invest in the Sydney market or the Brisbane market or even the Perth market, buying freestanding housing, you need a lot of dough to get into those markets. Regional markets are often a lot more accessible for investors. So I've seen some regional markets perform really well if it's sort of connected in with a more holistic plan for driving wealth creation, how you're going about doing it. If regional markets and regional assets fall into that, I think that makes a lot of sense. What I would say though is it's when regional markets often get, whether it's nefarious or otherwise, but manipulated by disjointed connectivity. And by that I would mean someone like Townsville, where you've had every sort of man and his dog, whether they're using a buyer's agent or doing it independently, because Townsville's been slated as a hotspot. Everyone's in there. Now, if you're in there early, great. If you're in there middle of the market, okay, you're probably going to be okay. But if you enter that market at the top of the market and there's no more room for growth, you're probably going to be
You missed the boat.
A statistic.
Yeah.
And you're going to end up being that person who bought a place and that's the only investment property you ever have because you get no capital growth for a long time.
So to round that around or summarize, I should say, I guess if there's some fundamentals in these regional areas that stack for growth, then obviously there can be some good investments. However,
absolutely, sure.
there's you got to time the market and what especially you look at Perth, for example. I think prior to this recent boom, and we'll say the recent boom has been maybe the last 4 years, it didn't move for like a decade, right?
Yeah.
And now people might be jumping on the bandwagon and saying that the last 4 years have been awesome, and they look at historical growth, assuming that's going to be future growth, but they might have missed the boat.
Well, property on average grows 6 to 7%, and the numbers come out recently, right? 7%, I think, nationwide is the average annual compounding growth for residential real estate. Okay, that's the way it's always performed. You've got areas in Perth have doubled in 3 years, 4 years. Now you got to, you don't need to be a genius to sort of put a question mark around that and go, why would that be the case? Well, if you have a look at it, the reason why is because it's done nothing for 10 plus years.
Yeah, exactly.
And I remember traveling out to Perth for some mortgage stuff 7 or 8 years ago, and every single real estate agent was sitting there with their heads in their hands, couldn't move a property, and investors were stuck who moved in there and bought at the top of the market, and they were pretty much locked out with negative equity, some of them for a decade. So all property markets work in cycles. The skill of the investor is making sure that you're investing in the right location, regional or otherwise, at the right point in that cycle for the right reason. A lot of people chase regional properties for perceived higher yields. Okay, that might help offset an asset that you have in a capital city, which is costing you a few bucks, but it's giving you capital growth. This is the intricacies of property investing, and it sort of comes back to the earlier point around who should you be leaning on in terms of helping to make those advisors and accountants. I got my accountant the other day, and we had this same discussion where I was sort of just musing around who should be the custodian of advice for the property investor, who should be your central advisor.
But so the accountant would give you the advice from from a tax structural perspective, like, maybe buy things in a trust and that type of
Yeah.
advice. But the accountant's not going to give you advice on, I think Townsville's a better market than Rockhampton or something like that,
No, no, and they probably shouldn't be.
Yeah.
And then the mortgage broker is a critical aspect of the advice. They're your debt advisor. They're giving you the fuel in order to be an investor. A good broker will understand what your goals and they'll understand what outcomes you're looking to chase, and they'll work really well with your other advisors. But their job is to ensure that you can get access to capital in a smart way, which is going to support whatever your goal setting is. Now, financial planners is interesting. Financial planning, they largely haven't touched property.
They're not really allowed
historically.
ASIC could really come down on them when they start, going in the realms of property advice.
Yeah, they get nervous about it again because it's unregulated. And you speak to a financial planner, they'll say, that industry was overregulated and it stifled the industry.
And
Now
they're slowly unwinding
they're slowly unwinding it now, and I think there's been some reforms tabled last year, which is helping to unwind it to make financial advice more accessible. It's inaccessible, good, solid financial planning advice because it's too expensive. And you see an accountant now,
and they wiped out the industry.
They wiped the industry out. If you go and see a financial planner now, I said, I'm thinking about buying this property in this location. They'll say, I'll advise you on that, but I need to do a statement of advice, which is going to be 60 pages, right, to actually do it. So who should be helping making the actual selection advice?
And there is a bit of a service gap there in the marketplace for consumers where, no one's really, or not many people are really speaking to a financial planner for superannuation. That has really been smashed in the last sort of like decade. Retirement planning, even just wealth creation outside of super. Insurances, people, there's been a hit in who's giving advice on risk insurances and life insurance policies, because that is what a financial planner should do. So it's good that they're recognizing that service gap, the regulators, and unwinding some of those aggressive changes.
If you're going to ask me to crystal ball what it looks like in the future, I think you'll find a lot of financial planning firms will start developing some sort of property related aspect to the service proposition.
Which there are businesses out there that are doing that already. I've seen some. I guess we somewhat have a bit of a property division, our Shore Invest, which we syndicate assets on. We did a shopping centre in the Gold Coast recently, and then we've got a separate financial planning business, and we've got to make sure we keep those separate from an ASIC perspective. But there are other businesses out there that have been doing it for a long time, where they've got brokers, planners, and property advisors, and it's working well. Some of them actually are previous guests on your podcast. The guys from the Property Couch, they're friendly. They've got a good service there. So let's bring this back a little bit. If you don't mind, I want to talk about your personal journey and some of your learnings and lessons along the way, because I know actually from some of those podcasts, like the gents from the Property Couch, that
I caught up with them the other day. They've got a new book, by the way. I don't know if you've heard.
No, I haven't. No.
That's good.
But they you were sharing some of your, you're also quite a very humble and modest individual, and you've actually achieved a lot personally with your own property portfolio. We don't have to go into the specifics and reference numbers on what that looks like, but maybe let's just talk a bit about, what you've personally found and where you've had some good wins. And, if you were to start again today, what would you do differently?
Yeah, good question. So one of the original iterations or the sort of nascent idea for the smart property investment was, we looked at the market sort of 15 years ago, probably when you were sort of kicking off mortgage broking back in the day when you had magazines and stuff. Right?
Yeah.
And you used to get these property magazines in news agents. You flick through it and just go, how I made $1 million overnight. And it's all just BS largely, right? And we sort of went, it doesn't really always work out that way. So I think we really need to get stuck into this. So it was one of the reasons why we created what we've created, and we still continue today chatting about it. Like warts and all, what is the realities of investing in property, right? Because you only hear the good stories, you never hear the bad stories. So about 12, 13 years ago, we said, let's put our money where our mouth is and do it ourselves. So we started building out a portfolio specifically to talk about it. So the smart property investment portfolio. We built that out. Had about 17 or 18 properties in the portfolio,
Wow.
which we built over probably a 4 to 5 year period.
That's a lot of transactions in
there's
that
a lot of
period.
transactions.
Yeah.
Use the buyer's agent throughout the whole process. Use the mortgage broker for all the loans, right? So really sort of understanding, going through that journey ourselves. The idea being is that we'll tell you warts and all what we've done right and what we've done wrong, and we'll be very clear about the errors and the mistakes that we've made.
That if my math is right, you're buying a property basically every like 3-4 months, right?
Yeah. And there's a whole bunch of different things. There was some duplexes in there. We bought a unit block.
All over Australia.
All over Sydney, Brisbane, Melbourne. So
East Coast only.
East Coast only.
And mix of metro areas and regional?
All metro.
All metro.
One in Wollongong, if you want to call that.
Yeah, okay.
Which has been a great performer of ours in Port Kembla, by the way, which is absolutely nuts. So we built it out to show, okay, we're gonna do this, and we're gonna show you where we get it wrong. Hopefully you can sort of learn extra. Now, fortunately, we've done it pretty well, and even our mistakes have been pretty forgiving. So, and the numbers are bonkers now, but we put a couple of $100,000 of original capital into it, so just savings, if you want to call it that. Went hard buying, and this would have been 2012 through to maybe 2014, 15 in the western suburbs of Sydney, when you were picking up houses for 250 grand.
Yeah, just before a little bit of a run there, right? Because it was still a little bit stagnant after the GFC in 2010.
It was the real late sort of the later part of when the GFC, the recovery was starting to take place. So we bought really hard. We put a couple of $100,000 into these to get it going, and then as the properties grew, we refinanced, redeployed. At a point in time, we pulled that $200,000 out and then put it in a back pocket. So we have a portfolio that owes us nothing.
Yeah,
right?
wow.
They're like, what's a
free portfolio, basically.
It's a free portfolio, right? People go, what's the cash on cash return? You go, I don't know, bazillion percent. Like there's no money in it. Obviously, we carried debt through that period of time and all that sort of stuff. But yeah, we built that out to about 17 or 18 properties in the portfolio, and the value would have been somewhere at its peak, probably about 12 or 13. Maybe.
And what do you, if there's a blended yield, what do you reckon the blended yield would be?
The blended yield would have been 4 and a bit,
And is that sort of your benchmark that you're targeting?
Yes and no. Look, we were okay to carry negative cash flow on it because we'll just look at the capital growth. So, our purchasing decision wasn't aimed at how do we ensure that the holding costs of the portfolio, was neutral. We're happy to carry a negative.
If it's a good investment,
posture,
it's a good investment.
We're chasing capital growth on it.
Yeah.
And it got to a point where that portfolio was costing us pre-tax cash flow probably about 60 or 70 grand a year to hold, but we'll perpetually increasing, recycling the debt. And then we stopped. And then you saw a very quickly change into, and it all sits in different trusts, with stuff moving into positive gear territory. So what remains of that portfolio now, we've sold off, 5 or 6 of the assets, taken the money out, redeployed it elsewhere. But that'll just sit there now and just grow in value, compounding at 6 to 7% year on year, and be pretty much it's pretty close to a neutral position right now. We won't refinance again. We'll just park it and leave it.
So I guess then going back to what you're seeing out there and relating it to your personal portfolio, and maybe a bit of a shift that we're seeing as well. What about residential versus commercial, right? How do you feel about those two? I feel that, to your comments about investors leaving the residential space, I think that's because in a lot of cities like Sydney, even Melbourne,
the yields are way too tight.
You can't make the numbers stack. Like negative gearing is good if there's capital growth.
Yeah.
But if there's been debatable growth for an extended period of time, you're actually losing money.
Losing money
for no reason, you know, and that's been the investors' flavour in Melbourne. A lot of houses have been negatively geared there. You might have got units that were, neutral, but the houses were aggressively negatively geared, and it just wasn't a good investment.
One of the, and you probably see it, and maybe you see it when your clients coming through. I think one of the greatest myths in property investment, residential property investment, is you're going to be able to create a portfolio that's going to give you $150,000 in passive income.
Yeah, I've seen that comment spooked everywhere.
It comes out all over the place,
Yeah.
and I would argue on one side of that, yes, that will happen maybe in 20 or 30 years' time if you don't refinance and you manage it really, really well, and you squeeze every cent out of it with ensuring that you're always at markets with your rents and stuff. Like, yeah, you'll be able to achieve that in that much time, but a lot of people are attracted to property investment thinking that they're going to create a positively geared portfolio in a couple of years and pay them $150,000 a year, and they're not going to have to work.
I think you're actually just referring to that book now. I remember seeing the cover of one of those previous guests you had on your podcast, How to Retire on $3,000 a Week. That's
that's Bill and Bryce's, right? And I actually I chatted to him the other day.
That's the $150,000 you're referring
that's
to.
$150,000. And I said to him, I went, and they said that's index linked, right? Like, so that'll be the equivalent of that at that point in time. And I actually queried and questioned them on. They said this book actually shows you how to do it. And I'm not saying it's impossible. What I'm saying is that it needs to be time bound.
Yeah.
And that's exactly what those guys are about. It's about you've got to get rich slowly would be their point.
And the key that they've put there is how to retire.
How to retire.
So focus on it as a retirement plan.
It's a retirement plan.
Not to retire by your 30s and 40s.
It's this idea that, you start investing in your 20s and you're not going to have to work ever again. Like, I just think it's a myth, and it's not fair to a lot of people to give them the perception that is actually achievable. A lot of people are going to not like me for saying that, but
manage expectations.
Manage expectations. So, this is the fundamental issue, and the point being around resi versus commercial. Like, resi ain't going to give you, if you're leveraged at 80% LVR, and you're building a portfolio and you're growing it, it's not going to be neutrally geared. It's going to be negatively geared. So be very, very careful if someone's telling you otherwise.
So then let's talk about then commercial.
Yeah, commercial.
So why do you see investors go toward commercial? So yield will be one, but yield comes with risk sometimes in the commercial world.
It does. And commercial's been interesting, and I've been doing a lot of work in and around the commercial space for 5 years now, and a lot of people have tuned into it. And I think it hasn't been it's probably a small reason why a lot of people have been attracted into choosing commercial property earlier in their wealth creation journey. So traditionally what would happen is that someone would buy a couple of resi properties and keep building a resi property portfolio. They get the 17 or 20 properties, and you sit there, and I don't know what your property portfolio is like. This is really first world problems that I want to say. But it's a friendly audience, right?
Yeah.
Certain people wouldn't like this, but you sit there and just go, I don't need to have 20 properties in a portfolio. It's a headache and it's a nuisance.
20 tenants.
It takes a lot of time and energy and effort, and there's all the work around it. Like, nice problem to have, right? But they'll sit there and have this realization of saying, this is good, and there's capital growth here, and I'm creating equity, but I still need money, right? Like, how do I actually get dough? And it's not going to be delivering you the passive income to put in your pocket that you want. So what's happening now, and what's happened over the last sort of 4 or 5 years, is investors have moved into commercial property earlier. So they might buy a couple of resi properties to start creating yield to chase the cash flow.
And what they do there, right? Correct me if I'm wrong. I guess the strategy and the advice that some of these property gurus do put forward to our clients is that you build your wealth maybe in the residential space. You get that capital growth that you're alluding to, and then in your late 40s and 50s, when you are preparing for retirement and trying to focus on yield, and you shift towards commercial, you might sort of deleverage and gear down from an 80% LVR on your residential portfolio, sell some resi property either to pay off the debt or move it to commercial and a lower LVR that has a stronger net yield.
Yeah, and that's a strategy that's working for a lot of people as they get to that point where they'll sell down resi and either retire some of the debt, and that would actually give them passive income over here, or deploy that. And for people in their late 40s and 50s, if you're in that cohort, you're probably entering the highest earning years of your life. It's where you're going to make the most dough, largely professionally.
You've also hopefully got some capital to play with,
Yeah, like you've got equity in the family home because you probably had it for a while. So you're at a really nice point to actually start thinking about building income for the future at
Mm.
retirement. So a lot of people are attracted to commercial for the view of yield. Now, one of the misnomers around commercial properties, people think you buy commercial property for yield, not for capital growth. But capital growth largely
It's there, yeah.
works in the same sort of basic.
It's almost more fixed in commercial because, this is somewhat speculative, but if you assume rates stay neutral, a lot of commercial leases have, maybe a 5-year, let's say, lease
Yeah.
has fixed increases in the annual rental income already in place, and so that's like basically having fixed growth because commercial values are
Priced in.
directly correlated to the yield and return. So if there's a 3 to 4% fixed increase on the lease for 5 years every year, then you're hopefully locking in 3 to 4% minimum capital growth.
Yeah, you're locking in the growth, but you're also in some ways buttressed against the cost of holding property because you get sort of triple net leases. So, your tenant is paying all associated costs connected with it. You got to cover the mortgage, right? But anything left is essentially covered by the tenant.
Yeah, let's not assume that everybody knows what we're talking about there. So let's just highlight that point. So big difference between residential and commercial property investment is that the tenant in commercial has to pay all the outgoings, has to pay if you rent a shop as a commercial tenant and the shop's tired, the fit out's on you, the renovation's on you. If there's a tap that's leaking, that's on you to fix. It's the polar opposite in residential. There used to be, I think they changed this recently, but it used to be the case that if the light globe was out, it was on the residential landlord to change the light globes and whatnot. So commercial is a little bit of a breath of fresh air for investors for that reason. Also, having 5-year leases is a bit of a breath of fresh air because you don't have this turnover every 12 or so months where you're paying a property manager 2-week letting fees to try and find a new tenant. You're normally also having to make some sort of repairs and maintenance upgrades in between tenants every 12 months, like sand the floors or paint the walls or replace a dishwasher or something like that. So it can be capital intensive for the residential
very capital intensive.
Yeah, for the residential landlord. Whereas commercial, much more set and forget, and your gross to net on the yield is a lot more lean.
Yeah, look, I'm attracted to commercial. I have commercial investments. And I look at the statement that comes in every month, and my commercial investments get very little visibility from me because it's largely set and forget. It's an asset. All the costs are covered against it. It's even though commercial rates are higher than resi rates, to a certain degree, but there's a lot more different financing functions around commercial as well. You can do lease stocks and all this sort of stuff, and there's some really smart banks out there with some really good policy around it. It's good business, and a lot of investors now are attracted to commercial earlier for all the reasons we've spoken about. Now, what's happened over the last sort of year or two is commercial yields have tightened. That we're not getting the returns that we were.
And those years you're referring to may have been COVID years because of low bit of cap rate compression from rates coming down.
Yeah, it's you've been able to get pretty reasonable yields over sort of coming out of COVID, particularly particularly with industrial and certain asset classes.
Yeah.
It's a lot tighter now, and people I speak to who I trust their opinion when it comes to commercial property, who are buyers agents, are now coming back into
commercial
to resi.
Oh, gotcha.
So there was some early movers who really embraced the opportunity to support clients in commercial property. But they're saying that the yields really aren't where they used to be, particularly at certain price points. So, it's very hard that they'll tell you to get really good commercial assets now under $1 million.
Under $1 million.
Under $1 million. And
to be honest, I have a personal opinion, which I've shared in previous podcasts. It's hard to get a good commercial asset under $5 million because, some of these commercial properties that people might buy, like let's say a shop on a main road in their local neighborhood, you've got one tenant, right? And sometimes these shops can take 6 to 12 months to lease if that tenant vacates. And that is the risk of a commercial asset. The good thing about residential, you can fill the property straight away with a tenant usually, where there's the commercial's so broad, and it really depends on the commercial asset itself. But some even, we've got some office space here in North Sydney, and sometimes it was 6 to 12 months of vacancy before we found a
Yes, I
tenant.
mean, it's tough and it's tight.
Yeah.
So be very careful what you're investing in commercial, and that's sort of good assets under 1 million, tough to find, even sort of 1 million to 2, because that's where everyone plays now as well, right? Most property investors, if they're more mum and dad property investors, are playing in that realm. When you start sort of getting over 5, it's different sort of money. You've got sort of family office type dough. There's a lot of cash in those markets as well. Family offices just putting cash into sort of 5+ million assets.
What I like about the 5+ generally is also hopefully you start getting multi-tenant assets.
Yeah.
So you've got less risk of losing your income. If you've got an asset that has maybe 3-4 tenants, and you lose 1 or 2, you're losing 25 to 50% hopefully of your income, not the whole lot. So you can bridge the gap between tenancies a bit more easily than having a single tenant asset, which you're wearing the cost for a period of time.
Yeah, the next sort of commercial thing I do will be a sort of smaller shopping centre. That might have been the regions, right? It's very different to resi. It's very different. Commercial property is intrinsically connected to business. That's why it exists. So if there's vibrant businesses and a demand and need for it, multi sort of tenanted those regional shopping centres with foundational tenants, and you do a lot of value add stuff with that as well, right? Because you normally get a fair bit of land space, and you can mess around with the parking and stuff. But there's really good sort of on-site development if you do your due diligence right. On-site developments where you can add value, right? How do you add value to commercial property? You add floor space, you change the tenant makeup and type, make them more diverse. And what you're doing in that syndication stuff.
Yeah, well, that's
to get exposure to that is great, but it's you need a fair bit of dough if you're borrowing it. If you're doing 70% LVRs, like.
Well, that one was an $86 million asset, so we can't do 70%.
Okay,
it was more like 55% LVR. But you're speaking my language there. It's music to my ears on the shopping center front. I love a good sort of retail neighborhood center as such. It doesn't need to be in a metro area. Like, I do love metro areas, but they're priced accordingly. The yields are a little bit more tight in metro areas. That one in the Gold Coast.
What was that? 86 million.
86 million.
So you're playing in insto land. Really.
Yeah. Well, that's our strategy, is to sell in insto land, to exit in insto land. We picked that up at 7.8% net yield.
Brilliant.
42 tenants, to my point about tenant diversity.
It's a big shopping centre.
Yeah, it's got an IGA, a Dendy's, and some good anchors, Guzman and Gomez.
Is Dendy's the good anchor, is it?
Guzman and Porto's,
Porto's
good anchors, and a Queen's Tavern. Good point about the Dendy's, but there was a corporate guarantee with the overall Dendy's.
I don't mind a Dendy's every now.
Yeah. But I've also invested, so that's our own syndicate. I don't want to sound biased that we're pushing our own. I've invested in syndicates with others as well. So Janellen has a syndicate business that I invest in. There was I don't know if you call this metro or sub-regional, but on the outskirts of Brisbane, Deagon.
Okay.
That was probably something a bit more like what you're alluding to. It was a small neighborhood center with just a independent grocer. I think it was called a Best Grocer. It was like a $23 million asset, returning about 6% at the time.
Bottle shop, bakery,
that type of
fish
stuff.
chip shop, all the usual stuff. Yeah.
And that's, I think, let's just highlight what you're talking about. You find a good grocer, that the grocer's the tenant, and then all the complementing retail around it, like the baker, the butcher, all that type of stuff. And those type of neighborhood centers are all over Australia.
Yeah.
And a lot of them are typically on one title. Even ones in I've seen some good assets like that be sold recently in the Central Coast.
Yeah.
And long term, they're very low risk and a no-brainer, really.
Yeah, as long as the maintenance, they're in pretty good sort of shape. Some of them are a little bit knocked about and need a few, but again, that's opportunity, right? You can really add value to these neighborhood shopping centers with some smart repairs and maintenance. But sort of $5-7 million asset, $10 million assets, they're in the, you can get into them as an individual investor. You need a fair bit of capital getting it, and you might be liquidating resi property or refinancing it to get into this sort of stuff. But when you start sort of getting 20 20 plus,
Mm.
that's sort of family office dough. And then when you start getting into your 80s, like you want exposure to that, syndicates can be a good thing. And a lot of people get nervous about syndicates. It's really funny. But I
Because
always
they feel like
remind
they don't have
people they
control.
don't have control, but
Yeah.
pretty much every single person invests in property in the syndicate.
Yeah, by their super fund and whatnot.
By the short, well, you're going in with a husband and wife.
Yeah,
It's a syndicate, right? Like
Yeah.
you're buying this asset together. It's a syndicated purchase. You're both
true.
largely responsible for the debt, and you'll both be on the title. So you're syndicated, right?
And the good thing is how I started investing in it before we launched it internally. I liked it because you're outsourcing the management to the experts, right? You're letting professionals deal with managing the leases and whatnot. Letting them negotiate terms who have got a career in negotiating terms and commercial leases, right? And something I appreciated through that due diligence process on the Gold Coast asset was how extensive the due diligence process actually is. It was like 4 or 5 months of nonstop work every
Every
day.
single tenant you would have been,
Yeah.
reviewing the specific leases and the integrity of their businesses,
Yeah.
everything. Like it's a big deal.
And to your point, yeah, we had the concern about dendies. What about, is movies in the future going to be a thing? And then we just assess, okay, well, it's like 4% of rent, so we'll take that risk and things like that. Like it's there's a lot of work involved, and the guy that we had running our sort of due diligence process, his background, Dan Farley, who's been in our podcast before, his background was buying assets for super funds for over a decade, close to 15 years.
They know what they're doing.
And that's the type of expertise that you need to run these syndicates, right? And that's generally the flavor of these individuals.
So for your Shore syndicate, I don't know what you call it. What's your sort of buy-in on that?
We had minimum
This is
investment.
me becoming the journo again.
Yeah. We had a minimum investment of $100,000. We might increase that next time around. It's only for sophisticated investors because it's under a wholesale license.
Yeah.
The asset was purchased on.
Can you explain sophisticated investors so people?
Good point. Yeah, now the journal is
coming. They're going.
Yeah,
my sophisticated investor. How do I get access to it?
Really good point.
Yeah.
Sophisticated investor is someone who is earning you got two ways to qualify: either that you are earning $250,000 or you have $2 million in net assets.
Yeah.
$2 million in net assets could be equity in your home and other investments. But if you've got one of the two, and your accountant signs a letter that you're a wholesale, it's a wholesale investor certificate to say that you're a sophisticated investor, then you can access these investment products.
So that's the basis of saying, because you've got that level of wealth, you're either sophisticated enough to understand the mechanics of money, and or you've got the money in order to pay for the right advisors in order to
exactly. You're understanding the investment decisions you're making. Because to your point, some people do get nervous with syndicates and not just that. There's other forms of investors, even private businesses that will require the same type of wholesale investor cert. But yeah, I think the other, to negate concerns in that world of syndication, if we talk about regulated products, investment products, like that is a heavily regulated investment product. Like it is a ASIC investment product. You compare that to, the average buyer's agent that's telling you to buy a property in a certain area. There's no regulation with that. Where for these syndicates, we've got to give quarterly reports. You've got to give annual tax statements. It's got to look like an investment in a super fund, essentially.
Yeah. And this is the missing link, coming back to property investment advice, is you've got all these investment instruments and vehicles highly regulated. Like I imagine the PDS for that would be a big, thick document, which would be, highlighting all the due diligence undertaken and giving a case for making the investment. The mind boggles that an investor buying a $700,000-800,000 property in Brizzy as my first investment is making investment decisions from unregulated advisors when it comes to it. Go figure.
Yeah.
I don't really. I don't know. I don't.
It's funny though.
know.
I feel like a lot of investors, they learn that the hard way, myself included. Right? I bought some residential investments in the past. One of them being an off the plan property that wasn't
How'd
the
that go
best.
for you?
Yeah. Well, it's still appreciated, but once you start looking at opportunity costs over time,
Not at
right?
the same speed as what it would elsewhere.
Exactly.
Yeah.
That's the only concern. And then you self-qualify to look at other opportunities, and you just look at that cost of capital and the opportunity cost and where else it could have been deployed. Which is why I've personally gone into that commercial realm. But yeah, it is funny how there is a lot of advisors out there basically acting like they've got a qualification in property investment, right?
Yeah, but I'm sure the industry will work its way out and sort its way out. What's the future of mortgage broking, do you think?
Wow, I should be asking you that question,
No,
right?
I
Because
know,
you're the one getting sponsorships from the banks, and you might have some inside intel there on
Yeah.
who's pulling back on sponsorships. But
No.
but yeah, no, I think the world of mortgage broking is going to be disrupted by tech and AI. That's for sure. I think the whole world is going to be
Yeah.
disrupted by AI. We see it as an opportunity, not a threat. We see it as a productivity and efficiency improvement. Even things like property investing and whatnot, I think AI can provide some useful data and insights for. I chat to my chat GPT throughout the day, all day, every day. And it gives, you actually have to be careful. I want to actually preface this. I've seen chat GPT give wrong answers on multiple occasions.
Oh, it gives it wrong
Yeah.
often more than it gives the right
Yeah,
answers.
I couldn't believe I tested it with something, and I made it do a loan repayment for 6 months. And it got the answer wrong because it divided the interest rate by 12.
Okay.
Yeah, so that's a pretty fundamental calculation to get wrong.
Well, it's got to be the difference between, the different emerging types of AI, but largely AI now is just pulling info that's in the system, and you got to think about it, right? If there's garbage in the system, if the information that it's pulling from is inaccurate, you're going to get wrong answers. And this is one of the biggest issues now. And I think with mortgage broking and all sort of advisory type practices, the intersection between information and whether or not it's misinformation or disinformation, right? This is a big thing, right? There's a lot of people deliberately putting inaccurate information into the system.
Yeah, I couldn't believe it. I'll give you an example. Even this morning before this podcast, I was just rehashing when was the last RBA meeting. I couldn't remember if it was the 7th or 8th of July. Reason being it was both the 7th and the 8th. And I quickly just hopped in Google and asked last RBA meeting, and the Gemini AI at the top section of Google now spat out the 19th of July or 18th of July. I was like, well, that's completely wrong. And it just confidently said the last RBA meeting was these dates.
Yeah.
It's crazy.
Yeah.
So yeah, you do need to
check your facts.
Check your facts. So look, Phil, we're running out of time. We've run out of time, I should say. There was more questions I wanted to jump in with you, but we covered some great stuff, and this just means we've got more of an excuse to catch up again in the future.
Let's do it. Let's get you on the Smart Property Investment Show. And
I'd love to be a guest. Sort of stuff. And let's get you back and maybe talk about how the world's changed in 6 to 12 months. Maybe there's more people in the world of commercial and hopefully not so many people taking incorrect advice from buyers agents. Let's hopefully see some positive news in the property market.
It's really, really good. And one of the things that gets really overlooked when it comes to property investment, everyone talks about where to buy and when to buy, but you only do that once. Then the idea is that you're supposed to hold on to these assets over time in order to maximize the return. How do you get capital growth? You hold on to a property. So property management's another whole aspect which really gets under. It's not the sexy part of property investment.
Well, yeah, we didn't actually cover that, but that was your prop tech disruptor that we mentioned earlier, just in your sort of intro. But managed is your business in the prop tech space, which is I think you said you've got 250,000 wallets now in that space. It's essentially a business that eliminates the need for a trust account in property management, meaning that landlords get paid the rent directly from the tenant. Is that right?
Direct and automated payments. So traditionally what happens is that when a tenant pays, goes into a real estate agent's trust account. They sit on that money for a period of time. Some boffin sits there and does a ledger and pays out stuff, and then will disperse to you at the end of the month what's left. So your money's held up in there for.
And I wonder what's next in evolving that business. Are you already doing things like adding services for the landlord to engage?
We have a lot of integrations across all that sort of stuff. What we've decided to do is really concentrate on direct and automated payments. So we want to make sure the property investor can get their money immediately sitting in their offset account, reducing their mortgage and probably reducing your commission though.
Yeah, but what about property management in terms of, actually managing the tenant in, maintenance requests and things like that? If the platform doesn't do
It does all that as well. So it does.
Oh, wow.
So it's essentially a property management operations engine for the property managers, so they can do inspections, maintenance, like all the stuff that typically happens. It does all of that, but it also does direct and automated payments, and that's the key thing. We invested in it. That's what attracted us to it, as property investors going, well, I want my money straight away, thanks, and that benefits me. That means I'm going to be a property investor. Plus everything that comes along with it. It's the compliance regime around it's pretty important. Your money's not going to go missing, all this sort of stuff. But we have a chat about that another time. Probably.
Well, yeah, we've run out overtime here, so let's dive into that and review everything that we spoke about in hopefully 6 to 12 months' time. Love to come on your podcast. Phil, thanks for coming on board.
Good to see you, mate. Good one.
Thank you once again to all our listeners today. Make sure you like and subscribe to wherever you listen to your podcast. This business is built on word of mouth, so please refer us to all your friends and family. They just want to stay tuned to the latest property and finance tips. Thanks again. Please note that this information is of general nature only and has been prepared without taking into account your particular financial needs, circumstances, and objectives. While every effort has been made to ensure the accuracy of the information, it is not guaranteed. You should obtain professional advice before acting on any information shared in this podcast.